All right, that being said, this is a multi-time frame strategy. I would also say a trend trading strategy. It makes you stay with the trend. That is one. It enables you to do multi-time frame analysis. That is two. And then it gives you a very high risk to reward entry model. All right, so number one, it's a trend trading strategy. It's a trend trading strategy. It's a multi-time frame analysis. The risk to reward is high. The win rate is high. And the technicalities is simple. So I need to put this out there. It's a trend trading strategy. It's a multi-time frame analysis. The risk to reward is what? High. And the technicalities, they are very simple. So a good place to start is I'm going to go step by step. And for anything I'm trying to teach, I would actually explain the story behind it so that you fully understand how this is happening. All right. So, number one, in technical analysis, or let me say, when they talk about smart money concepts or institutional kind of trading, it is believed that for you to identify the trend, two things must happen. Number one, and just a moment. You must have, for a downtrend, you must have first a change of character and a break of structure. That is one. The other part is for an uptrend, you must have what? A change of character and a what? A break of structure. Basically two breaks. But we are not going to be doing any of these technicalities here because not like they don't hold water, but the approach we are going to be using is something that is going to be very effective, or I'll say a bit more effective. So, these are the rules you must keep in mind, right? If you use 4 hours for entry, you're using 30 minutes. If you use 4 hours for analysis, you are using what? 30 minutes to enter the trade. If you use 1 hour, you're using 15 minutes. If you use daily, you're using 1 hour to enter. And then if you use 30 minutes, you're entering with 5 minutes. So let's put down those rules and make sure that you understand. I'm probably going to write it again. So daily time frame for analysis, or let me just put it this way. Daily equals 1 hour. 4 hour equals 30 minutes. 1 hour, 1 hour equals 15 minutes. And 30 minutes equals 5 minutes. Because it's not because this is really, really special. It's just because we want to have an idea of what the larger time frame is saying. Remember, time frame is fractal. The markets can be in an uptrend on daily and be in a downtrend on 1 hour or even 2 hours. But we want what we call time frame alignment. And by time frame alignment, if the daily is buying, the 1 hour should be buying. If the 4 hour is buying, the 30 minutes should be buying. If the 4 hour is selling, the 30 minutes should be selling. If the 1 hour is selling, the 15 minutes should be selling. If the 30 minutes is selling or buying, the 5 minutes should be what? Selling or buying. This is very important. All right. That being said, how do you align the time frames together? We are going to be using the trended price oscillator. It's an indicator that mathematically calculates the trend of every time frame and gives you the direction for the day or for the moment or whichever time frame you decide to use it on. But we are also going to be using it with these rules. Come in, let me just put the box here. We are going to be using it with these rules, which you see here, right? So the trended price, please note this is derived trading view so that we can use more than two indicators. Remember, the normal trading view might not give you access to this. So if you want to access this particular trading view, just go to Google and search derive trading view. Then look at it here. I think the first one that shows with charts. All right. There's the derive trading view. All right. That being said, so daily 1 hour, 4 hour, 30 minutes, 1 hour, 15 minutes, 30 minutes, 5 minutes. Now that this rule has been set, what is the next thing? Rule number two, you impute your what? Detrended price oscillator. So let's say we are using daily for those of you who usually do not have time and you want something that just gives gives you opportunities that you can hold for a long time, then the daily time frame is for you. And your entry will be what? The 1 hour. Let's use any pair on volatility. Let's just say we'll do two volatilities, two forex. Like we'll touch at least two examples, buy, sell, buy, sell, buy, sell, so that you have lots of opportunities or lot of information. All right, so this is the daily time frame, right? And we said the first tool we are using to identify the trend is what? The trended price oscillator, isn't it? So I'm just going to click on indicators and search the trend. So if I just type DET, you can see it over here. You can put it as favorite so that anytime you want to access it, you can always have it there. So the trended price oscillator. Now, when I click on it, there is something peculiar about this tool, which you must understand. It has a 0.00 line or a 0.00 figure over here with a line in the middle. You can see this line here. So I'm just going to double click on the indicator to make it a bit, look at it, the zero line. Let me make it really dark and then probably increase this thing and make it something like this so that it is a lot more visible for me to relate with. Now, this is the Detrended Price Oscillator. It's simple, like you don't have to think too much about analysis. And I really want you to follow through. I'm trying to see if there is a way to hide this. I'm trying to see if I can hide. Good. So that I can have a lot of space to teach. Good. Now, looking at this Detrended Price Oscillator, anytime this green goes below the 0.00 line, that's this thick line. So let me just put a line here. And then let me probably change this red, right? It is telling you for example, currently on volatility 10S. Seeing this line go below 0.00, it is simply telling you that we are in a confirmed downtrend. And I really need you to pay attention because we are going to also be using or lots of simple price action techniques to really make so much money with this, right? Now, when it goes below the 0.00 level, that is this line which you see here, your bias for that day, remember, you're using 24 hours, or whether you're using a different time frame, you are not looking at buying in any way, form, or manner. You are only looking at what? Selling. Remember, I told you if you use 24 hours for analysis, this is the first time frame, right? What other time frame are you using for entry? You are using what? 1 hour for what? Entry. So you have a bias that is showing you to sell. What do you do next is you go to what? 1 hour time frame. This is where things begins to get interesting. Remember, if the daily bias is a sell, or if the higher time frame bias is a sell, your lower time frame bias must remain with a sell. This is very important. If the daily bias is what? A sell, your lower time frame must be what? A sell. Now we are currently on what? 1 hour. And this is where a lot of things start getting interesting. Remember, on daily, this was where we marked, isn't it? This class is very important. I really wish we are more than this number. Let me just, because informations like this, like I said, I might not even upload this video on YouTube, though it's being recorded, but I have certain reasons why I'm making that statement. So let me just use the next 30 seconds again to let people know that they have to be here. Because after now, tomorrow we have a live stream session. Don't forget. Uh, just a moment. Let's try your possible. Just a moment. Just give me a moment. Let me pause the recording. Yeah. All right. So now, like I said, 24 hours, right? Daily. Remember the rule. 24 hours bias, 1 hour entry. 4 hours analysis, 30 minutes entry. 1 hour analysis, 1 hour analysis, 15 minutes entry, isn't it? Then 30 minutes higher time frame bias, 5 minutes entry. Now let's continue. And these where things start getting interesting. We use 24 hours to do the analysis and we are using 1 hour. Now note, look at how it looks like on 1 hour time frame. Even if you are guessing, that is, even if you don't know how to trade, just because you are doing a multi-time frame analysis, the chances of already being right has already kept you in a 50% position to succeed. Just imagine all this move naturally, everything doing nice. But how do you enter? And this is where the technicalities start coming in place. The first mode of entry is we have a tool that naturally classifies or gives you a sniper entry model in line with the trend. All right. It gives you what? A sniper entry model in line with the trend. So how does it work basically? It's a case where the next tool you must use is a Bollinger Band. Now, the reason for this Bollinger Band is because I don't know if you guys can hear me. I hope the network, if you can hear me, just a thumbs up so that I know that everybody's following. Oh, thank you. Thank you, Mike. Just a moment, because I'm having no network on my device, so I just need to be sure that village people are not involved into this class. Don't worry about the timer. I would send a new link if this gets exhausted. All right. Now, here's where things start getting interesting. As much as you want to stay in the trend, right? You also need something that gives you a very perfect entry. A very what? Perfect entry in line with the trend. Now we're on 1 hour, right? Take a look at this. Just watch. Notice the top part of the Bollinger Band. So let me show you. We are looking at sales. Am I correct? Yes, we are looking at sales. We want to sell at a point where we are certain that price could possibly be reversing. Take note of that. We want to what? Sell at a point where we are certain that price could what? Possibly be reversing. And this is even more important because Yes, we are using multi-time frame to trade with the trend, but can our entry be so perfect in such a way that we might not experience drawdowns? So what this means is the Bollinger Band acts as a what? Support and resistance entry model, whereby if you are selling or if your bias is a sell, you must take entries at the top of the Bollinger Band. So it's more like your bias is a sell. You are selling at what? The resistance of the Bollinger Band. So this, just watch this. Let me look for, I think we have some more. We have already, just barely looking at this, you can see how great and effective it is, but this is not everything yet. Just stay with me. We have this over here. We have this over here. We have something like this. We have this. We have this. Do we have any other one? Sorry. Let me see. All right. Now, as much as I marked this, it must also align with this. So, what do I mean? If you have a bias on 24 hours, watch. Remember, our bias was because everything is below the zero line. Now, this is where it gets interesting. And there are two ways to enter. Number one, the perfection or the perfect way to enter is whenever price gets to the top part of the Bollinger Band, that is this part, our DPO must still be below the zero. For example, look at this over here. This is our first sell. Are you seeing? Price at or price below the zero. Remember, both time frame alignments must align. Higher time frame must align with lower time frame. So 24 hours, we have our DPO being below 0.0 on 1 hour. While price is touching the highest part of the Bollinger Band, price has to also be below what? DPO. Now, this is like a very perfect way to enter. This is a second example. So, how do you take a trade? The moment you have a bearish candle confirmation, because in this entry model, you don't use a pending order. You put your stop loss above the Bollinger Band and you target a 1:3. All right. So in this case, we didn't get a 1:3. What we got here is just, I think, barely 2.63, which for me, I would, of course, probably break even, right? Now, let's continue. If price gets above the Bollinger Band and our DPO is not beneath the 0.00, I will show you how to use this. But now look at this. Price, top of the Bollinger Band, right? Let me bring this down a little. And where is our DPO? Of course, you wait for a reversal candle and then your stop loss above the Bollinger Band, and then you target 1:3. Now, we have another opportunity here. Price touches the top part of the Bollinger Band. Let me remove this. And we have another 1:3. Are you seeing this magic? Let me go back a little. So we have first trade, second trade. Please note, for every of this trade, notice that DPO is below where? The zero line. Remember, our bias stemmed from where? The 24 hours. These are for those who don't want to waste so much time, or you don't want to spend time looking at 5 minutes volatility and how fast the market can move. You can just use daily, 24 hours. You already have your bias for the day. Nothing is changing your bias. And then you come to 1 hour to seek entry positions, right? To seek what? Entry positions. Now let's look at other entries. Now, this is a sell, beautiful sell, but what do we have here? Price above what? DPO. So we can't take this. Now, let's look at this particular one over here. So we have a reversal here, and then price is below our DPO over here where we have this. Okay, no, so in this case, look at this. Price is above DPO. Now, someone would want to ask, sir, what if it crosses back? Now, if it crosses back at this point, make sure that it has not gone below the midpoint of the Bollinger Band, and this is very important because at this point where you want it to cross back so that you can enjoy the trade, it's already moving in your direction. Like, it price has already moved, so it's a case where you're having something like this. Your stop loss becomes a lot more bigger, and trying to hit a 1:3 might become a little bit challenging at this point. All right, it might become a little bit what? Challenging. So in cases like this, let's see this. If you must take a reversal, it must not cross below the midpoint of the